Welcome, everyone. Today, we're diving deep into one of the most powerful wealth building tools available to real estate investors, the 1031 exchange. Specifically, we'll explore its nuances within the dynamic California market. This strategy allows you to defer significant capital gains taxes, freeing up more capital to reinvest and grow your portfolio. It's a critical component for any serious investor looking to maximize their returns and build long-term wealth in real estate. As a quick reminder, don't forget to download a copy of this presentation from my training website so you can study it and take notes. The link to the training website is in the description of this video. And if you enjoyed this training, be sure to subscribe, like, and comment. Your feedback helps us grow and reach more agents like you. Over the next few minutes, we'll cover 5 essential areas. First, we'll establish the core concepts of a 1031 exchange, understanding its fundamental power. Next, we'll walk through the step-by-step process of executing a successful exchange. Then, we'll delve into California's specific rules, including the unique clawback provision. Following that, we'll conduct a strategic analysis, weighing the benefits against potential drawbacks. Finally, we'll discuss real-world applications, providing practical guidance for implementing this tax strategy effectively in your investment journey. At its heart, a 1031 exchange is a provision under Section 1031 of the Internal Revenue Code. It allows real estate investors to defer capital gains taxes when selling an investment or business property, provided they reinvest the proceeds into a like-kind replacement property. This isn't a tax avoidance scheme, but rather a tax deferral strategy. It's particularly relevant in California, where high property appreciation and significant combined state and federal tax liabilities can easily exceed 30% of your gain. California investors find 1031 exchanges particularly appealing due to several compelling factors. The potential tax burden on appreciated investment properties can easily exceed 30% when combining federal capital gains, state taxes, and depreciation recapture. With median property gains often reaching $500,000 or more over typical holding periods, deferring these taxes means preserving 100% of your capital for reinvestment. This allows you to leverage your full equity into new, potentially larger or more diversified assets, accelerating your portfolio growth significantly. Executing a 1031 exchange involves a structured process with strict timelines and rules. It's not simply selling one property and buying another. There are specific steps that must be followed precisely to ensure the exchange qualifies for tax deferral. Understanding this framework is crucial for any investor considering this strategy. We'll break down each stage, from the initial sale to the final acquisition, highlighting the key requirements and best practices to navigate the process successfully. The first critical step is selling your relinquished property. This property must have been held for investment or business purposes. Examples include rental homes, commercial buildings, industrial facilities, or even vacant land intended for investment. It's important to note that your primary residence or any property held primarily for personal use does not qualify for a 1031 exchange. The intent of holding the property is paramount, and it must be clearly documented as an investment asset. Engaging a qualified intermediary, or QI, often called a 1031 accommodator. This is not just recommended, it's mandatory for a valid 1031 exchange. The accommodator acts as a neutral third party, holding the proceeds from your sale. The golden rule here is that you, the investor, cannot touch the money at any point during the exchange. If you do, the exchange is immediately disqualified and all deferred taxes become due. Selecting an experienced accommodator or QI with proper insurance, strong financial backing, and a proven track record in California real estate transactions is absolutely crucial for success. Once your relinquished property closes, a strict 45-day clock begins for identifying your replacement property. This identification must be in writing and unambiguous. There are specific rules governing how many properties you can identify. Either 3 properties of any value, or any number of properties as long as their combined fair market value does not exceed 200% of the relinquished property's value. Missing this 45-day deadline means your exchange fails and taxes become due. Following the identification period, you have a total of 180 calendar days from the sale of your relinquished property to close on one or more of your identified replacement properties. This 180-day window runs concurrently with the 45-day identification period. In California's competitive market, this timeline can be challenging. It requires proactive planning, quick decision-making, and often pre-identifying potential properties even before your initial sale closes. Missing this deadline also results in a failed exchange. The like-kind requirement is often misunderstood, but is actually quite broad. It simply means that any type of U.S. investment real estate can be exchanged for any other type of U.S. investment real estate. For example, you can exchange a residential rental property for a commercial office building, or vacant land for an industrial warehouse. The key is that both properties must be held for investment or productive use in a trade or business, not for personal use. To achieve a full tax deferral, the replacement property you acquire must be of equal or greater value than the relinquished property you sold. Furthermore, you must reinvest all of the equity from the sale, and the debt on the replacement property must be equal to or greater than the debt on the relinquished property. If you take any cash out of the exchange, or if your new debt is lower, that difference is considered taxable boot and will be subject to capital gains tax. While 1031 exchanges are a federal tax provision, California introduces its own layer of complexity that investors must understand. The state generally aligns with federal IRS guidelines regarding timelines, like-kind requirements, and the role of qualified intermediaries. However, California has unique reporting requirements and a specific provision that can impact investors, especially those who diversify their holdings outside the state. California largely follows the federal IRS guidelines for 1031 exchanges, including the critical timelines and like-kind definitions. However, the state adds its own reporting requirements. Every 1031 exchange involving a California property or a California resident must be properly reported on your California tax return, regardless of where the replacement property is located. Strict documentation is essential, and failure to report correctly can lead to audits and penalties. It's vital to work with tax professionals experienced in California real estate transactions. One of the most significant California-specific rules is the clawback provision. Here's how it works. When you defer capital gains on a California property through a 1031 exchange, California tracks that deferred gain. If you later sell the replacement property, and it's located outside of California, without performing another 1031 exchange into another California property, the state can claw back those previously deferred California capital gains taxes. This can lead to unexpected tax liabilities years down the line, so careful planning is essential. A crucial aspect of a successful 1031 exchange is the debt replacement requirement, which helps avoid taxable boot. To fully defer taxes, the debt on your replacement property must be equal to or greater than the debt on your relinquished property. For example, if you sell a property with $800,000 in debt and acquire a replacement with only $600,000 in debt, the $200,000 difference is considered taxable boot. To avoid this, you would need to add an additional $200,000 in cash equity to the exchange. Beyond tax deferral, 1031 exchanges offer a multitude of strategic benefits for real estate investors. They are a powerful mechanism for accelerating wealth creation, optimizing your portfolio, and adapting to changing market conditions or personal investment goals. Understanding these advantages can help you leverage the 1031 exchange to its fullest potential in your investment strategy. The most immediate and significant benefit is the deferral of substantial tax liabilities. California investors often face combined federal capital gains, state income tax, and depreciation recapture rates exceeding 30% of their gain. A 1031 exchange allows you to defer all of these taxes, meaning 100% of your sale proceeds remain available for reinvestment. This significantly increases your purchasing power and allows your capital to continue working for you, compounding your returns over time. 1031 exchanges enable powerful portfolio growth through compound interest as you reinvest pre-tax dollars. they also offer immense strategic flexibility. You can optimize your portfolio by consolidating smaller properties into larger, more efficient assets, or diversify a single large asset into multiple smaller ones. You can achieve geographic diversification, moving equity from high-cost California markets to areas with better cash flow or different growth potential. Finally, you can pivot your strategy, shifting from residential to commercial, or from management-intensive properties to triple net leases, adapting to market changes or personal preferences. Consider this: selling a property for $2 million with an $800,000 capital gain. Without a 1031 exchange, you might pay $240,000 in taxes, leaving $1.76 million to reinvest. With a 1031 exchange, you defer that $240,000, allowing you to reinvest the full $2 million. That extra $240,000 in purchasing power can be the difference between acquiring a mediocre property and an excellent one, or even acquiring an additional property. It directly translates into greater asset accumulation and accelerated wealth building. While incredibly powerful, 1031 exchanges are not without their complexities and potential drawbacks. It's crucial for investors to be aware of these challenges to make informed decisions and mitigate risks. Understanding the strict timelines, the commitment required, and the long-term implications will help you navigate the process successfully. The strict timelines are arguably the biggest challenge. You have 45 days to identify replacement properties and 180 days total to close on them, starting from the sale of your relinquished property. The IRS offers no extensions for weekends, holidays, or any other reason. This demands meticulous planning and often requires having potential replacement properties lined up even before your initial sale closes. Missing these deadlines means your exchange fails, and all deferred taxes become immediately due. It's important to remember that a 1031 exchange defers taxes. It doesn't eliminate them. The deferred gain carries over to your replacement property. If you eventually sell that property without another 1031 exchange, those accumulated deferred taxes will become due. However, many investors continue to exchange properties throughout their lifetime, potentially deferring taxes indefinitely, and ultimately, their heirs may receive a step-up in basis, effectively eliminating the deferred gain. If you want to know more about the step-up rule, subscribe and watch my upcoming training. The downside of a 1031 exchange is that once an exchange begins, your flexibility is limited. Changing your strategy midstream can trigger immediate tax consequences. Furthermore, your capital remains locked in real estate, reducing liquidity. Accessing cash for emergencies or retirement without paying accumulated taxes becomes difficult. The compliance complexity is also significant, requiring precise documentation, legal review, and coordination among multiple parties. Small mistakes can be very expensive. Finally, California's clawback provision means state taxes can follow you even if you move equity out of state, creating potential future liabilities. A 1031 exchange is a powerful tool, but it's not for everyone. It's best suited for investors focused on long-term growth, portfolio optimization, and building generational wealth through real estate, who are also comfortable navigating strict timelines and complexities. However, you might reconsider if you need liquidity soon, are nearing retirement, or are uncomfortable with the intricate compliance requirements. The bottom line is that a 1031 exchange is a strategic tool for committed investors. It requires strict compliance, professional guidance, and careful planning, but offers immense potential for tax savings and growth. Always work with experienced tax advisors, qualified intermediaries, and real estate professionals who understand California's unique requirements. As a quick reminder, don't forget to download a copy of this presentation from my training website so you can study it and take notes. The link to the training website is in the description of this video.